Right now, I want to talk a little bit about the equity markets, Tobias, and where you are, and maybe also touch in here how Wall Street's going to enjoy Dow 30,000 or wherever we're going. Are we a bull this morning, Tobias?
I'm a modest bull, or a moderate bull, or a short-horn bull, however you want to call it. I do think there's upside, but it's not going to be that fabulous, as we have to kind of absorb higher rates, some inflation, alongside some of the uncertainties out there. If it's the midterm elections coming out, what the Fed's going to do. There are a number of kind of forces that are restraining kind of great enthusiasm.
Your joy years ago was being an in-the-trenches security analyst, which means you get very granular about companies. What are you hearing from companies? We see the reports of share buybacks. No one's really surprised by that. The cynics aren't surprised by that. Is there an investment spirit? Is there an animal spirit among large multinationals?
There is, and we can track it. In terms of, we look at what's about 780 companies are doing in their capital spending programs. And in February, when we did the study, and these are all non-financial, because financials tend to run their capital spending through their P&Ls. But if you just look at the cash flow statements, planned capital expenditures, they were up about 8% for 2018 back when we did the study in February. When we redid the study in May, we saw them up about 11.2%. So they accelerated, particularly in the technology area. Mm-hmm. So there is something going on. If it's 100% depreciation write-offs in the first year, if it's better confidence, better profits, something is driving this increased activity.
Tobias, are you expecting much more volatility in the markets? We saw it last Tuesday. This was triggered by Italy, but actually then kind of infected world markets. And if you do, what does it mean for U.S. equities?
So we do think there'll be some increased volatility. And one of the things we have, I know you guys talked to him as well, Matt King, who's our global credit strategist, does a fair amount of work looking at central bank purchasing activity at the same time fixed income issuance. And there's about $1 trillion of less purchasing activity of fixed income instruments by central banks coming this year versus last. And at the same time, there's about $1 trillion of more issuance than we saw last year. So just technically, less demand, more supply, you would probably see some credit spreads widening. And when that happens, volatility also picks up. Not a disaster, but there is some volatility likely in the next few quarters. And, there are different ways you want to play that as an investor. One of them could be buying some bio and pharma stocks that don't have the same sensitivity. They're driven by FDA approvals and things like that, not Fed policy.